Hello again, everyone. This is Gene Ahrensberg coming to you from our HQ in Southeast Texas near Houston on Sunday, November 4th, 2012. Here in the U.S., pre-election uncertainty reached a peak on Friday as immediately following the non-farm payroll figures, which miraculously showed a gain of 171,000 jobs and a 7.9% headline unemployment rate, the U.S. dollar jumped higher and gold and silver knee-jerked sharply lower. I don't know about you, but I'm ready for this way too long campaign season to be over with. And as much as the signals we review give us hope for a Romney-Ryan victory on Tuesday night, we strongly suspect that we'll have to wait until the wee hours on Wednesday to get the good news. We'll see soon enough. Up until Friday, gold and silver were holding their own, more or less treading water, but when the payroll figures came out, the bears gave everyone a lesson and stopped triggering again. Gold was off 2% and silver closed the week 3.7% lower, with all of the damage coming on Jobs Friday. We could not have known it at the time because the CFTC Commitments of Traders report is not released to the public until late in the day, but the big funds apparently sniffed out the coming weakness ahead of time. They were reducing their net longs for both gold and silver by Tuesday, as we'll cover in just a moment. Gold in euro terms fell 1.1%, and the U.S. dollar index firmed up 52 basis points. Notice, however, that the ICE commercial traders are still only showing a very tiny 4,000 contract net long position for the greenback index. That's hardly a vote of confidence in the paper dollar versus the other paper promises, the other fiat currencies. The big miners in the Huey more or less answered gold and silver this week. They were off 3.4%. But be sure and take notice of the GDXJ only off 1% and the CDNX actually closing the week a little green. We have to view that positively. Looking briefly at one of the subscriber gold charts, the daily tracking and trading chart, the retreat for gold has picked up steam, and the Friday break below $1,700 tripped bunched up sell stops, enough to send gold through the 1680s, setting up a test of the 50% Fibonacci retrace level, which coincides roughly with the 200-day moving average. So we might look for gold to form support in the 1660s on a weekly closing basis. Moving to the longer-term weekly chart, we could see gold finding support just about anywhere between here in the 1670s and the downtrend line of the giant flag formation gold broke out of in September, call it near $1,630, and close to the 61.8% Fibonacci retrace level. Back to the one-year chart. Since we vultures were stopped out profitably on October the 15th, we felt pretty comfortable on the sidelines, especially since the COT report has not really improved all that much, as we'll see in just a moment. There is enough nervousness and worry ahead of the U.S. elections to keep everybody guessing just ahead, but that distraction ends on Tuesday. At least we certainly hope it ends on Tuesday. As we talked about last time, gold ran into determined opposition in the areas shown in yellow, call it $1,775 to $1,800, but it had gotten overbought on a short-term basis, and as we'll see in a moment, it had also run into quite a bit more opposition from the big sellers of gold futures. What we're going to see in a moment when we're talking about the COT data is that the pace of reduction of the large commercials hedges is not what we want to see if we want to re-enter in this dip. Not yet. And just to recap our view of the action, gold broke out and moved well above that giant flag formation on anticipation of global QE and massive money printing by the world central banks, which was well telegraphed by Dr. Bernanke and Mario whatever it takes Draghi for the European Central Bank. But once that news finally surfaced, it became a world-class liquidity event, a sell the news event, if you will. But that's temporary. Also, just to reiterate our own thinking, we think that probably means that significant to strong dips should be bought, with appropriate trading stops, of course. But we definitely want to see the COT data giving us an assist showing us the kind of signs that the smartest, best funded players in the world are of the same mind, so to speak. It's one thing to look at all the QE, all the huge money printing, and understand that just about has to be inflationary. It has to be dilutive for fiat currencies. It's got to be good for gold over the long haul. But it's another if we want to buy the dips. But the largest commercial traders are not acting like they think the same way we do yet. Perhaps a better way to say that is that we want to re-enter gold and silver, but we only want to do so if the COT action is supportive of that notion. But once again, we're getting ahead of the story, so let's move now to the positioning of the largest traders of futures in gold on the COMEX in New York. We can do that by looking at the CFTC Commitments of Traders reports and by charting the changes each week on the graphs we use to understand them. Looking first at the Legacy COT report for gold for the combined commercial traders, which includes the producer merchants and the swap dealers, we can see that as gold ran into more determined resistance in the 1770s in early October, the natural hedgers, the bullion banks, the large bullion dealers, the refiners, the processors, jewelers, and other big users of gold, many of whom trade through just a very few large bullion banking firms or have the bullion banks manage their hedging for them. The traders we refer to as the big commercials had built up a very high level of hedges, 269,000 contracts at the time, and we know it was very high because, as we said then, the big commercials hedges were equal to a whopping 56% of all COMEX contracts open. That was a critical level back then, and we said so in no uncertain terms. We said then that the COT called for caution for both bulls and bears. The COT was at the point where if gold had gone higher, it could have resulted in a powerful vertical move higher for gold as the commercials were forced to cover their hedges like we saw in August of 2011. But it was also a critical point from the other possible direction, and the most likely, as we said then too, that the price of gold would likely retreat so the market could rebalance. Since then, as one can easily see in the data, the price of gold has declined, and for 4 consecutive weeks we've seen the big commercial net short positions also declining. Indeed, in the 4 reporting weeks since October the 2nd up to Tuesday, October 30th, as gold gave back about $65 or 3.7%, the big commercials had covered or offset about 46,500 contracts or 17% of their collective hedges. The good news about that is that as gold came down in price, there were fewer hedges. The less than good news is that that's not really the kind of robust pace of hedge reduction that gives us bullish enthusiasm. Not yet, anyway. Having said that, look at that last line of data. Notice that for this week, gold actually edged about $2 higher in price, and yet we see the big hedgers reduced their hedges by 9,901 lots, or 4.3% for the COT week. Now that is a positive sign by itself. Not enough to make us do something right this second. Now let's look at the graph for the combined large commercial traders so we can see the action visually. On this LCNS graph, the blue line tracks the large commercial net short positioning. And remember, all this data was before the Friday jobs report $35 spike sell down where gold tested as low as the 1670s. And remember that New York was virtually shut down for Monday and Tuesday of this week due to Hurricane Sandy. So this is the LCNS, or large commercial net short position graph, and as anyone can see, the blue line is moving lower as the number of commercial net hedges declines. Our contention is that the chart is moving in the right direction, just not at a fast enough clip to suggest that the hedgers believe gold is done moving lower. We can see more about what we're talking about when we compare the LCNS with the total open interest on the COMEX in the next graph. Here's the relative commercial net short positioning, which we call the LCNSTO. It peaked on October 2nd, well up into the warning zone at 56%, and it's coming back down to a more neutral 49%, but not yet low enough to give us bullish enthusiasm. Before we move on, here's the bottom line of the legacy COT for gold. The big hedgers took a big stand when gold reached obvious resistance. They turned out to be right, and gold has since begun a pullback. As gold has been pulling back, the hedgers have been getting smaller, which is what we expect, but so far, at least up through this past Tuesday, the pace of hedge reduction has not been enough to motivate us to re-enter on the long side of gold. We happen to hold physical gold and silver, and so we have the luxury of waiting for what we believe is obvious opportunity, for when we think the odds greatly favor our entry, possibly at the expense of missing some profitable trade setups. We don't attempt to game every small bull move for gold or silver. Instead, we want to be on board for the major bull moves when we can get into position for them, like we did in June and July of this year, which resulted in our catching our share of the bull move then and booking a $129 the ounce short-term profit when gold hit our stop on October the 15th. The setup for silver is very similar to gold, except that the lack of hedge covering by the big commercials is at an even slower or smaller pace than we see with gold. Let's take a look. Like gold, the big commercials net short positioning peaked on October 2nd at a high 57,840 contracts net short, but notice that the LC and STO only made it up to 41.6%, quite a bit lower than with gold. Since about 2007, an LC and STO for silver futures of 40% or higher has become a kind of warning level, like a 50% LC and STO is for gold. In a moment we'll look at the graph so we can see it visually. Notice that as silver had retreated about $2.80 or 8.2% in the 4 weeks since October 2nd, that the big hedgers, many of whom trade through just a few bullion banks and large swap dealers because of the efficiency of their hedging and their management business, had reduced their collective net short positioning, but only by about 4,100 contracts, or about 7%. When we see silver correcting 8% and the LCNS only falling by 7%, that is not, repeat, not a brisk pace of commercial hedge reduction. That says that the big hedgers had positioned as though they expected silver weakness, and a mere $2 or $3 pullback was not yet enough to change their thinking. However, before we move to the first silver graph, notice that in the last line of data, kind of like gold, for the COT week ending Tuesday, October 30th, silver actually added 10 cents, and the big hedgers actually reduced their net short positioning by 1,767 lots, or 3.2%. So even though silver was higher in price, a little, the big hedgers saw fit to reduce their net short positioning. That 1 week is a positive sign. But even so, it would not have been enough to turn us bullish on silver by itself. Here's the LCNS graph to see the action visually. To put the graph in context, back in June, when the price of silver, then under $27, the big hedgers were so not worried about silver moving lower in price that their combined net hedging was at an 11-year low of only about 12,000 contracts. We said then that was a very, very bullish condition, and it turned out to be at an important bottom, as we expected it would be. But as silver rose in price in the most recent rally, the big hedgers were compelled to put on new hedges at a pretty brisk pace all the way up to 57,840 contracts on October 2nd, which, as you can see, is a fairly high level of commercial net shortness. The LCNS has been higher in the past, but notice please just how much higher from the low this event was compared to the moves higher in the recent past. The LCNS went from an 11-year low to a very high level in just one uninterrupted move, which is pretty rare. That very high net short positioning told us that the largest, best funded, and presumably the best informed and connected traders of silver futures were of the firm opinion that silver had gotten ahead of itself in a material way. As it turned out, they were right. Sure enough, silver ran into resistance near $35 and began a retreat in early October and hit our trading stop October 15th. We booked a dandy $5.30 profit on that trade, or the equivalent of about $26,500 per COMEX contract. It should be obvious, but in case it isn't, we relied on the positioning of the largest commercial traders in COMEX futures to send us signals in that last silver trade. We used those signals to decide whether to tighten our trading stops, those purple lines on the chart, or leave them well under the trading to allow for more volatility. The higher the commercial net short positioning, the more likely we are to employ a tighter stop strategy, and vice versa. We have found that to be very helpful over time for our short-term trading. And just to be perfectly clear, we're only talking about our short-term trading here. This has nothing whatsoever to do with our holdings of physical gold and silver. As silver was running into resistance in September, the big commercial traders kept on adding to their commercial net shorts, and finally, in early October, the LC and STO moved up into the caution zone, so we went to a tight, near-resistance stop strategy, then finally getting stopped on October the 15th for a nicely profitable trade. Today we have focused on the legacy COT reports, and they're very useful for what we do with our position trading in gold and silver futures and ETFs. For years that was all we had to work with, but a few years ago the CFTC expanded the categories of traders to separate out the swap dealer category of commercial hedgers, the more mercenary of the traders in the gold and silver pits, and they also separated out the other reportable traders in the non-commercial category, the very large traders who take positions in futures for their own book, as opposed to managed money or the funds who trade futures on behalf of clients. As longtime Got Gold Report readers and vultures know, we track the so-called disaggregated COT the same way we do with the legacy COT, and from time to time that gives us additional signals that help us to decide what to do in our own positioning. For this particular week, for example, notice in the weekly recap, which we publish each week on the blog, that with gold and silver actually slightly higher, the funds, the big specs, were actually liquidating a sizable portion of their net longs ahead of the surprising non-farm payroll report on Friday. Now, of course, we didn't see that ahead of the $35 smackdown for gold on Friday, because it comes out at 2:30 on Friday, 3:30 New York time. But it tells us that at least some of the funds had a sense that something was about to happen that would give the bears a short-term assist. What it tells us is that as the current week unfolded, with New York shut down Monday and Tuesday, the funds had already shown a good measure of weakness the previous week by the previous Friday. So the bears were gaining control of the trading pit at that time. Gold has since then corrected a good deal more on big volume, and silver too. We prefer to concentrate on the positioning of the big hedgers for our most important signals. We do so because doing so has been good to us more than not over the years, and we do so because at the end of the day the positioning of the big hedgers reflects the expectations of the largest, best funded, and probably the best informed traders of gold and silver on the planet. The people who literally have to hedge their metal inventories, their gold and silver in transit, their gold and silver on order, or needed for future production of goods, their metal soon to be produced but not yet sold, their metal already sold but not yet received from their source, and on and on and on. There are tons of people who use futures to hedge their metal positions, including the bullion banks who manage large metal inventories for a myriad of clients worldwide. If we let them, the big hedgers can help us to decide how and when to either tighten our own stops, our trading stops, or leave a lot of room for the trading to allow for much more volatility. As just a quick example, note the violent change in the swap dealer net positioning for silver futures just since June, when they were record net long by 19,681 contracts, compared to October 16th, when at 11,052 contracts net short, they were the most net short silver they had been since 2008. As Billy Crystal might have said, hello. In a future video, we intend to dive a little deeper into how we use the disaggregated COT today. But that's enough about that for now. Remember again, all of the COT data we've reviewed today was reported before the Big Friday sell down, just 4 days before the U.S. elections. As we said in the graph updates this week, since being profitably stopped on both gold and silver October the 15th, the sidelines have felt comfortable. We expect to stay there at least until the dust settles on the election and the outcome accepted by the population. Remember also that as useful as the COT data is, it's only one of the many indicators we use in our deliberations each week at Got Gold Report. It's only one, but it is an important one. And in the final analysis, we absolutely have to remember that the futures market, as important and as big as it is, merely answers to the much larger and more important physical and forwards markets, located primarily overseas. The way we like to look at it is that the futures market is a window into a very large house. The positioning of the big traders we can see after a short lag. It's like being able to see into one room of the house 3 days ago. That may not sound very helpful on the surface, but when we're talking about trades that last many weeks or months, it's a heck of a lot better than not being able to see inside the futures market house at all. Now, with the very limited time that we have left, we'd like to call attention to a couple of the tiny junior companies we have taken an interest in that practically no one knows about or is following yet. As we said in our most recent Vulture Bargain update, we are of the opinion that the market for junior miners and explorers has recently bottomed in a spectacularly wicked seller exhaustion and is just now in the beginning stages of a new cyclical bull market. This is the chart we use to track the Market Vectors Junior Gold Miners Index ETF, or GDXJ, with the more diverse Canadian Venture Exchange Index, or CDNX. Right or wrong, win or lose, we have been adding to our own positioning in quite a few small juniors that have been pummeled by what we called in our presentation at the New Orleans Investment Conference the second worst junior bear market from hell. Our contention is that the smaller juniors are consolidating in a flag after a bottom breakout. Time will tell if that is correct, but confidence will return to the market as prices advance. It's just a question of when and how fast in our view. Now, we won't go into all the details why in this video, but subscribers know them well. This is the chart for Timberline Resources, which is on path to becoming the next gold producer in Montana and is currently trading at a price that assumes they have zero gold in the ground. We urge readers to do some due diligence on Timberline and to become familiar with their story. Over the years, Timberline has consistently found overwhelming support in the area shown in green on this longer-term chart. This is a monthly chart, and over the years, this soon-to-be high-grade gold producer has rewarded those who stepped in to buy the shares in this range. Timberline trades on the NYSE market, formerly the Amex, under the ticker TLR. Important catalysts just ahead include final permitting news in Montana, an expected preliminary economic assessment for their exciting Lookout Mountain project near South Eureka in Nevada, and mine commissioning next year for their Butte Highlands JV. It may not look like it by looking at that chart, but this is an exciting time for the TLR crew. By this time next year, they and their 50% JV partner ought to be producing about 40,000 ounces of high-grade gold per year from underground. The development ramp has already been excavated thousands of feet to within a few yards of the pay zone under Nevin Hill near Butte. We have time for one more, and this is the chart for Channel Resources, which trades on the Venture Exchange in Canada under the symbol CHU and in the U.S. gray market under the symbol CHJRF. Now get this, we're gaming Channel because of what they have already put on the resource table, so to speak. Over 1 million ounces in all categories of shallow, easy-to-mine gold in Burkina Faso, within spitting distance of Orezone's Bombaré, Voltus Kiaka project, and Riverstone Resources Ligeti project. Channel was driven lower by the terrible bear market for junior miners to what we consider a ridiculous cheap price it trades at today, and they have had one particular seller liquidating a large position for many weeks. There is so much more to know, but the large seller has to be getting low on shares, so we think that artificial weakness is just about done. We urge those who are non-risk averse to check it out and do some due diligence before it snaps back up to where it belongs. Possible catalysts for Channel Resources include some expected soil and geochem coming on two promising anomalies just north of their Mankarga 5 deposit in the very highly prospective Tanluca project. Check it out, but don't waste much time doing so. Channel is not likely to stay in the stupid cheap range much longer, in our humble opinion. By way of disclosure, all of the Got Gold Report staff and I personally hold long positions in both of the companies mentioned. And I wouldn't be surprised if somebody consolidates that district around the Ligeti and Bombaré district sometime in the next little while. Well, that's it for this Got Gold Report video. Until next time, good luck, good trading, and good vulture bargain hunting. We'll see you all again next time. Bye for now.